Welcome to a new edition of Market Signals, and we are recording this on Tuesday, September 27th. Your host here, Jeffrey Roach, Chief Economist for LPL, and joined by Marc Zabicki, Director of Research and also the Chief Investment Officer. Marc, how are you?
Doing well, Jeffrey. Good to be with you.
We do often see each other in person in the office, but Market Signals here recorded virtually. So unfortunately, we have to switch back and forth, home office to real office. But either way, here we are, Market Signals, important disclosures. Remember, we are careful about how we talk. We're not talking about guaranteeing, and certainly not wanting to assume we know the future. So some of these comments will be forward-looking in nature, but the limitations of us here. So there we go. Hot topics. We'll talk about the pound, talk about a little bit of oversold conditions. We'll talk about the aggressive nature of recent Fed activity. And then hot off the press this morning, as we're recording Tuesday here, we were heard from the conference board that consumer confidence improved. We'll talk a little bit about that, what that might mean. And so there you have it, our roadmap for today. And as always, your research team is available to help you, assist you in any way, and glad to be available. Reach out as always with questions. So pound sterling, right off the bat, we do have a colleague going over to the UK in a little bit. I actually came and did my visit a little bit too early, Marc. Apparently, if I waited a little bit, I was over there with the family in June. And if I waited a little bit, things would have been cheaper, would you say?
Could have saved some money there. Every economist is interested in saving a little money, right?
Exactly. So you can't time it perfectly, but hey, at least we didn't go over there 2-3 years ago. But pound sterling hitting all-time lows. A lot of new people in office over in London, particularly that's adding some volatility. We are seeing kind of this new budget. We talked about this a little bit yesterday, Marc, in our strategic asset allocation committee meeting. As advisors know, we meet regularly as a committee to hash through events of the week, of the day, and what that might mean for portfolio allocations. But any thoughts as we dive into some highlights here with what's going on in the currency markets and fixed income markets, Marc?
Sure. I think the Federal Reserve has got us our eyes trained on the dollar and the dollar strength, and the dollar's been across most currencies out there. The dollar is really strong, and based on the actions of the Federal Reserve, I mean, you could probably take a look at the dollar right now and raise a little bit of an eyebrow and ask the question of how parabolic or how straight up effectively that the dollar could go, thinking that at some point we may in fact show some weakness in the dollar in the weeks or months ahead, meaning that it can't continue to go up in a straight line, and especially if we get some inflation readings that are a little bit more palatable, and if we get some concept that maybe the Federal Reserve will have to go or do less work in terms of policy. Maybe a little bit of a breather causes a little bit of a breather for the dollar, and probably a little bit of breather for risky assets, honestly.
Yeah, exactly. So this graph, for those of you that may be listening while you're exercising, showing a graph here on the relationship with the dollar pound exchange rate, as well as the 10-year gilts for the UK. And so what's happening, across the pond here is, and I can appreciate a lot what's happening over there. I have a very soft spot for supply side economics in my heart, and enjoyed reading and thinking about Art Laffer, being in graduate school at Clemson University. And so as a supply sider, when I'm reading about tax cuts and trying to make the environment a little bit better for both consumers and businesses alike over in the UK, I think, okay, well, that's great. That's healthy stimulus. But at the same time, if we're seeing, all right, there's an aspect of stimulus that will be inflationary. And so, I think markets are very nervous about inflation getting even worse than it currently is in the UK, and clearly putting downside weakness in the pound. And you can see this graph. I actually put this graph together before yesterday's trading activity, where the pound even weakened even more. But the point is that it's in relationship, as Mark, as you just said. A lot of it not only is just the supply side conversations that's happening in the new government in London, but also the fact that the U.S. central bank has been very aggressive in raising rates, and in many ways, ceteris paribus, has upside pressure on our own domestic currency. But clearly something to watch out for, adding to the overall global volatility in the markets right now. I think that's the point that we wanted to highlight in this podcast. As you talk to clients and you talk to folks about markets, what's adding to some of this market volatility is some of the other very aggressive central bank activity, mentioning here, as well as Bank of Japan. We'll just put that in passing. So next hot topic, moving on to sentiment. Mark, you can add some comments here, but wanted to put it over to you. We in the top of the podcast, just highlighting some of our hot topics for this edition. The second hot topic here is some of the sentiment numbers. This is the first of two graphs, but in terms of equities and volatility, Mark, what do you think, and how should advisors think through what's happening right now?
Sure. I mean, there's we call this tool for the toolbox number one, and there are plenty of sentiment tools out there. This is just one that I kind of historically have looked at for kind of a long time, just almost as a common sense check-in on how markets are reacting relative to volatility. So what this is basically, as the nameplate indicates, the S&P 500 trailing 1 year return to volatility ratio on a weekly basis. So what this means is, when returns are high and volatility is low, you have this ratio appearing on the upside of this graph. When S&P 500 returns are low and volatility is high, the ratio will appear on the lower end of this graph. So it's basically a measure of extremes. So we sometime in 2021, as this chart shows, reached an extreme in optimism. Clearly overbought conditions, as this chart would point out. And now we've kind of conversely reached an extreme in pessimism, oversold conditions that, if this chart goes back, call it, 10 years, 11 years, is the time frame that we're looking at. There is no lower point over the last 10, 11 years than that point that we see today. So almost an extreme low in sentiment, based on what we are seeing in this chart, which common sense kind of tells you that when you see these types of extremes on the high and the low, that the market is almost in a coil spring kind of mode. And if we get any kind of good news, and this is your arena, Dr. Roach, is, maybe we get some good news on inflation. Maybe we get some good news from the Federal Reserve relative to inflation. And, in a coiled spring effect, we get a bounce back in risky assets. So from a contrarian perspective, although sentiment's decidedly weak, the market's been down notably over the last several weeks. Some good things perhaps to look forward to if we do get that bout of good news.
Yeah, that's right. And so it's a great segue for, where we'll go in the next slide, thinking about these extremes and what could be the impetus to kind of move us back from one extreme to another extreme. You use that coil component here. So you think about where we are from an investment sentiment standpoint, bullish, bearish. And so toolbox number 2 here showing on the screen. I think it's a great natural next step to add to what your earlier comments are, Marc. So
yeah. It's a tool for the toolbox number 2. Again, there are multiple different tools in the toolbox: sentiment, fundamental, technical, and otherwise. But I mean, we're looking back 12 years in this chart here. The American Association of Individual Investors surveys those that responded in a bearish fashion are 65% in the last weekly reading, which is a historic high over the last 12 years. So again, a contrarian would tell you that you may want to bet the other way in terms of what this chart shows you. Extremes in pessimism generally typically lead to reversals in the level of sentiment out in the marketplace. So again, if we're looking at the tool for the toolbox number 1 and the number 2, we can perhaps deduce that the market may be in a position for that coiled spring rebound should we get that piece of good news. On the inflation, maybe the PCE number this week, Dr. Roach can get us there, but who knows? I mean, I do think from a market strategy and an asset allocation perspective, we are indeed in pretty definitive oversold territory here. So, and the retest of the lows in June we saw yesterday, we are today getting that bounce, which is good news and probably not much of a surprise as we bounce off those June lows, because they're obviously an important level of support here.
Yeah, that's great. And I think, the natural follow-up to that then is to say, okay, we're at this extreme level of bearishness. Why? The so what, or how did this happen? And I think that kind of flows real nicely into this next chart where we're saying, okay, I think part of the reason why we're seeing such negativism is in response to an aggressive Fed that's never been this aggressive historically. And so in this graph, we're just saying, okay, given all of the various tightening cycles from the last several decades, let's look at how the Fed has hiked and how they've tightened over time and at what speed. And so this dark black line is the current tightening cycle. And you can see that by far and away, this is a tightening cycle that's happened much faster in magnitude than any other tightening cycle. And I think that's kind of that natural iteration of this conversation with folks saying, okay, why are people bearish? Why is the market nervous? Okay, we talked about the unusual nature with, the UK and how currency markets are trading. Let's add to the storyline an aggressive Fed that is tightening faster than they've ever done before. And I think in some ways that kind of makes sense, where you see, all right, the Fed's typically in the last several decades, you can kind of see this fact that the Fed never really tightens above the previous peak in rates. You kind of, you see high rates and then they start easing because of economic weakness. They start tightening again. They never quite reach the previous cycle's peak. Not so this time around, right? It's a whole new era in the sense that the Fed said, all right, given the fact that we have such unusual characteristics in the stickiness of inflation, we're going to hike. We're going to be aggressive. We actually heard this again yesterday, which was Monday. The Cleveland Federal Reserve president was talking about the fact that rates need to be higher for much longer. I think that's really changing market expectations, even in the last 48 hours about what rates might look like going into 2024 now. So I think that's part of the challenge. Markets responding to a very aggressive Fed, tightening much faster than they normally fight. So
Hey,
go ahead, Mark. I think
just
you want to follow up on this.
Just to actually out of curiosity here, just from your perspective, how much of what the Fed is saying, which I think we're taking the Fed at its word, it's going to continue to raise rates somewhat aggressively, and maybe not quite on a 75 basis points level of aggression, but how much of what you're hearing from the Federal Reserve would you categorize as jawboning?
Well, I think they're what we call jawboning is what they call forward guidance. And so, in previous FOMC kind of cultures, particularly with Bernanke back in the day, one of the tools that the Fed actually had was not just, adjusting short-term rates and money supply and interest paid on excess reserves and all these other things that they do. Forward guidance is a real tool. And forward guidance just means in everyday English, it just means that the market needs to hear what the Fed's planning on doing. So the forward guidance means Fed saying, hey, we need to see rates here, or we won't change our policy until we see inflation moving in this direction. And all of that kind of conversation is important. And I think part of the way that the markets respond and financial conditions tighten is by the forward guidance, just the talking. So the fact that they give speeches saying we're serious about inflation fighting, we're also mindful that we're talking about a long run average 2% rate. So I think in many ways, when the Fed can be convinced that inflation is easing, and it's unequivocal, inflation easing, going in the right direction, I think in some ways that is just as good as that forward guidance saying, all right, we're moving toward this 2% target. And it'll take a little bit of time, but moving to a plus 8% on the CPI to 7, that's a move in the right direction. If we're looking at the deflator, moving from an upper sixes to a 6% year-on-year rate, which we'll most likely see at the end of this week, I think that's actually going to be fairly positive for the markets and investors, knowing that inflation is moving in the right direction. So forward guidance is a legitimate part of what the committee members do in going around giving talks.
And that's some of the base case in terms of our work as a strategic and tactical asset allocation committee at LPL Research, with some of the work clearly that you're providing, Jeffrey, in terms of inflation outlooks. We do think inflation is going to ebb here. The question is degree and how fast we get back to some more palatable inflation numbers, and that's why we're a little bit cautiously optimistic here as we get this bout of extreme pessimism. If we do get some inflation numbers that are within expectations or better than expectations and show that continued trend of deceleration inflation, then I think the market likes that a little better, don't you think?
Yeah, exactly. And it's funny too, just to bring up something. I had a conversation with some friends and they were saying, well, okay, what's the deal with you economists and market participants talking about core inflation? Isn't it true that food and energy are very important for the average American household? The answer is yes. And the reason really for the focus on core is its statistical properties. It's easier to forecast and model out when you take out some of the highly volatile components. But the bottom line is headline numbers are important. And the Fed actually has stated that the headline numbers are important. And that's why on Friday, I think it's very important for all of us to focus on the fact that given the decline in energy and gas prices and some components of imported food prices, services, we're starting to see that headline number ease a little bit. And I think, before we, end the podcast, it is fair to say, well, is there anything positive to talk about? We talked about some of the historic just moves, particularly in pound sterling, I'm thinking, but the moves in Fed policy, et cetera. What's good? Is there anything positive? And I think we can actually give some good news and end on a positive note, because this morning, Tuesday, we had a rebound in consumer confidence. And, one of the things that, we often look at is, those leading indicators that suggest when a recession hits. We're going to actually talk about later this week in some other deliverables that we do here out of LPL Research, talk about the fact that a spike in unemployment, as the Fed has warned, it is really consistent with a recession. So we're talking about increasing the call and the risks of recession next year. But if you think about where we are this year, particularly in the third quarter, you think about the fact that July, August has been pretty a little bit better, pretty calming from a consumer standpoint and from some of the pricing standpoint. Now, granted, July and August was short-lived in terms of how equity markets were moving. September has been a whole nother story. But this latest uptick here in this graph, just showing consumer confidence overlaid with the gray column there, showing the official recession as defined by the National Bureau of Economic Research. And you see this uptick. That's for September. September moved back up to triple digits. 108 is the latest measure for consumer confidence. And the reason why I think it's important is something that you can take away, I think, as advisors, you talk to your clients and thoughtful about how various age cohorts, income cohorts are experiencing the current economic environment a lot different than any other cohort. So, the Consumer Confidence Board Conference Board gives us the numbers broken out by age. And I thought it was worth highlighting on the podcast, just because people don't often talk about this. But again, it kind of gives you an edge as you access LPL Research. What do we give you that's non-consensus or not necessarily hitting mainstream media? And one of the things I thought was worth highlighting is that when you break out consumer confidence by age, there's a very different experience for those under 35 versus those over 55. So kind of looking at, the barbells of the labor force, if you will. And that dark blue line there, the under 35s, everybody took a hit during the pandemic and had a little bit of a head fake, coming into 2021. And then we realized the nagging influences of inflation and then eventually a war from Russia has depressed confidence. But if you kind of just look at that, eyeball it, from 2019 to where we are currently, the under 35s are pretty close to pre-pandemic levels. And it's a lot different experience than the over 55s. And the reason I think that kind of connecting the dots here between confidence and what we're seeing in the labor market and why the labor market's so tight, you have all these openings, you don't have enough unemployed people looking for work. It seems to be this this frustration with the over 55s. And I don't know if it's perhaps maybe, a frustration with what the hybrid work environment might look like. Maybe on the positive end, it's the, wealth effect, the fact that, the over 55s have a much larger a war chest than the under 35s, and they can weather kind of taking a time out, if you will, a gap year or a two. Thinking of those after college, but it's a lot different. I don't know, Mark, if you want to comment on this. It's interesting thinking about just the different experiences based on where you are in demographics.
Yeah, probably hard to pinpoint, Jeff. I mean, just in terms of the over 55 folks, is maybe we've got a situation where they're over 55, perhaps more on a fixed income, and then the gas prices were really eating heavily into that inflation, eating more heavily into that perhaps than the under 35s really digest. And then, maybe some of the lift that we've seen in today's number is related to honestly, oil prices, gas prices, which have in fact come down. I mean, we're at like $77 ish WTI this morning. So there's probably some semblance of a direct correlation with oil prices and consumer confidence. And as we know, oil prices affect, nearly four corners of the economic system and when it comes to inflation. And so having oil prices kind of ebb here, which is an expectation of us or of ours, by the way, certainly is helpful to all three of these lines, probably.
Yeah, that's right. And so if you take that narrative that the over 55s are taking the gap year or two, that by definition means they're going to be on a fixed income, whatever they're drawing from retirement, right? They don't have, a paycheck to play off of. And so that clearly kind of adds to that storyline. And I think, one of the things that we need to see in order to provide real salve for the markets is this kind of this recovery from these 5 million folks that are on the sidelines, that were in the workforce pre-pandemic. They're still on the sidelines for whatever reason. We really need to see a greater labor force participation rate in our economy, and particularly those that that are the over 55. And here's the really good news. I think this is where we can wrap it up, talking about the next day and the remaining days of this trading week, and that is, out of Tuesday morning's consumer confidence report, we saw that inflation expectations for the average consumer is well anchored. That's one of the things that you'll hear out of policymakers when they talk about forward guidance and talk about plans and talk about, how tight will they be and for how long will they continue this aggressive rate hike. A lot of this hinges on inflation expectations. And sometimes it's a little confusing. I think when I talk to end clients, they say, okay, it really is important because it affects consumer behavior today. Today's behavior is based on tomorrow's expectations. And so we don't want a runaway inflation expectation and people, clamoring to get things now, stock up on things now because they're nervous about future prices. And in the details of this consumer confidence report for September, we saw an even better improvement that inflation is expected to come down. Consumers are reporting that, and they're acting upon that. And that clearly does add a little bit of, salve, thinking about how aggressive will the Fed have to be. But inflation expectations are well anchored. But here we are. It is a busy week this week. We feel like we say that every week. So Tuesday, as you can see, I highlighted consumer confidence. Wednesday, Thursday, and Friday, I would say the biggest one is probably the Friday number, Mark, as you've already highlighted a few times throughout our remarks on this podcast. But the preferred metric of inflation, the PCE deflator, it's based on the personal consumption expenditures of the consumer here in the U.S., what they're actually selling, what they're actually buying, and in what proportions, I think gives us and central bankers the best read on how inflation is impacting consumers. We'll get that 8:30 Eastern on Friday morning. And we are expecting the headline number to march on down to 6% year on year. And we expect in the coming months to finally break below 6%. And that will clearly add confirmation in our view that inflation has decelerated, has peaked and decelerated. So, Mark, what do you think? Anything you want to add?
Well, I think the timing is interesting. Just we took a look at two indicators from a sentiment perspective, and they're both at pessimism peaks over the last 10 or 12 years. And then we're talking about Friday perhaps getting a nice look at an inflation number that may in fact be continuing to trend lower. So we combine the two. Good news on inflation perhaps on Friday, peak pessimism, current state of the union today. That makes for that perhaps that coiled spring type of a reaction we may get from risky assets. So something to kind of digest here in terms of the way to think about market positioning. And I know over the last couple of weeks, watching the market go down on a material way is not easy to digest from a behavioral perspective. But right now we may be on the cusp of getting some better news from an inflation perspective. We're certainly in the throes of that deep pessimism, and that maybe provides a level of opportunity for investors and some respite for those investors who have been allocated to equities and other risky assets over the next couple weeks. So we could see a little bit of a tradable bottom here should we get a PCE number that actually is more palatable.
Yeah, that's exactly right. Well said. And as always, we're thankful for your business. Thank you for listening. And until next time, feel free to reach out to us for any questions and support. Take care.